This week we have 3 webinars lined up for you. First is soft savings trend among Gen Zs. In this webinar, we're gonna help the Gen Zs to switch towards smart savings and set themselves up for the future financial success. Second is health insurance decoded, your first step to financial security. Protect your wealth by making sure your health is covered first. And the last one is direct versus regular mutual funds, maximizing your returns with right choice. In this webinar, we're going to explain how expert advice could help you maximize returns and navigate market volatility. Register using the below link and join without fail. Thanks.
Hi everyone, welcome to this episode of Talking Straight with Shyam Sekhar. We have a series of questions that we asked Mr. Shyam, and without much ado, let's get straight into the series. So we covered the international markets now. Coming back to India, you've been quite vocal and optimistic about the Indian markets and the Indian economy, right? So, but then why exit small cap or sectoral or thematic funds now? Why not stay invested in them?
See, where earnings is the primary driver of valuation, I don't see a merit in exiting, as long as the valuations are within a reasonable band. But where liquidity is the driver of valuation, where people are simply blindly buying and continuously buying, and they are inflating the valuation because of their need to deploy money, there I feel that one should take a step back and move capital to safety. Often, I could even be early in this, but I value that safety far more than the kind of voyeurism that people generally tend to practice. The money that we manage doesn't belong to us. It belongs to an investor. The investor has got a lot riding on that money. He's got goals coming up. He's got duties to be fulfilled. He's got responsibilities that are all time bound. So this money cannot wait indefinitely. And whenever valuations go out of whack, completely out of whack, they will actually behave in such a manner where their valuations can remain depressed for a very long period of time, right? On the one side, you have an investor who has got timelines for everything, and the valuations don't have a timeline by which they will come back. I don't want these two situations to confront each other at any point in time. So an exit is merely avoidance of this conflict and confrontation, maybe in a prudent way. But such prudence is required because first, you don't have this conflict or confrontation ever. The second point, suppose the event actually happens where all these valuations contracts sharply or collapse. At that point, you can actually go back and buy the very same themes. There is nothing stopping you. Nothing is cast in stone. You are taking a call on the risk management based on your belief that liquidity is the primary driver of valuation and not business earnings. Whenever you are completely convinced on that, I believe that you should move money to safety, and that's exactly what I keep doing.
So now we spoke about exiting thematic, sectoral and small cap funds, that is predominantly exiting equity. So, and markets are also volatile, right? So what is the ideal client asset allocation that you're looking at? Is there any key strategies that you're recommending?
See, generally as the markets go up and valuation go out of whack, I would think that progressively you have to reduce equity. What can you raise on the other side? You can raise gold, you can raise silver, you can raise arbitrage, you can raise debt, you can raise InvIT, you can raise REIT. These are the prominent assets which you can raise in order to reduce your equity risk and your equity exposure. But these have to be done progressively and in a particular sequence. You can't just do them in any way you like. Closer to a interest rate direction change, that is, either the interest rate bottoms out or tops out, whatever it is. You have to make a call on these other assets also. Suppose interest rate is going to top out and start moving down. Around that point, you must have completed debt, you must have completed InvIT, you must have completed REIT, because those assets will start getting valued better. So, my approach broadly is, as I see valuations keep going up, either I'll allocate in equity only in very selective parts of the market where I'm convinced on the valuation, where the valuation downside is not as high, as the other areas. Suppose your money is in the other areas, then I would take out money from those areas and put it in these other asset classes and build them up. So effectively, I think that if you are a dynamic asset allocator today, your equity could be somewhere between 60 and 70. And if the market goes up further, it should reduce a little bit. Is this bad from a return point of view? I think not, because as I told you, an investor's duty is to protect himself from a drawdown to the best extent possible. You can't completely protect yourself because you can't sell everything, but you can sell a few things and you can be ready to buy. And by virtue of selling, you protect yourself. So this, you have to do it. And this is what we have been telling our clients. It is not as if we are bearish on the entire market. We take a valuation specific view in specific parts of the market. And we'll continue to do that all the time.
So I thought as a house avoids investing in NFOs and IPOs, right? So are you not missing out on potential opportunities? Like, are there not anything that is worth taking a chance on?
See, if an NFO is done in a space which is completely neglected by the market, where there is no interest, and where we feel that the potential is high and the market is completely neglecting it, there we would not be averse to participating. In fact, we would like to participate. But that's not the case of today's NFOs. NFOs are all coming near the peak in a theme. And I know for a fact that notwithstanding amount of money that an NFO will raise, these stories can definitely turn for the worse. It's not as if simply because you have raised money, you cannot fall. Market is oversimplifying these things. According to me, when there is a compelling need to pursue safety, you should not pursue risk. It's as simple as that. I think in most of these IPO bound teams in mutual funds, I think they are riding on the momentum rather than the fundamentals. And momentum is transient, it's not permanent. So whenever that momentum reverses, you will find that all these people will cut their positions because they can't keep on giving margins, right? So when that happens in the F&O, that will reflect in the theme. So it's a negative spiral that can very well happen. I don't want to take that risk on behalf of an investor. I'd like to take those risks only when I am confident the risk will play out, not like some kind of a blind bet in any of these thematics. I believe that most of the thematic IPOs have been wrongly timed, and I don't want to buy them because my investors don't have such pain bearing capacity. Also, there is one more point that's very, very critical. That is, I will never invest in a mutual fund scheme where I have not seen the portfolio. NFOs don't show you the portfolio. So, I think that I don't want to invest blindly on the reputation of the fund house or the reputation of the manager. I want to see the portfolio. I think that is something that is non-negotiable. And because of that, we don't participate in IPOs generally. But in our history, we have participated in some close-ended small cap IPOs, probably in 12-13, and they really killed it. Those IPOs made a lot of money. But I'm not seeing such a compelling reason now. Maybe we'll have to wait and see.
Fair enough. Today, money is a dinner table conversation more than ever, and people are moving into higher income brackets. Right? That means the future generations have more wealth to manage. Right? How important is engaging with the future generations in meaningful financial education today?
It's very, very important. Firstly, the needs and demands of the future generation in education and in their finishing school requirements, skilling, is very high. The financial need is very high. And many a time, parents don't discuss the kind of sacrifices they make to fund those finances. And the children also grow up as if that's not their problem. I think that all these things don't lead a family to a better place. So it's very, very critical that you have financial conversations. Often, I have seen parents have conversations with children saying that here is this money. If you go and start working and if you make this as an investment now, it will grow for you in 8-10 years. But if you spend this money just to buy respect through some degree, maybe a postgrad or something abroad or an MBA in some second or third tier institution, you'll still be spending a lot of money. And that money may not give you any return. So think through it. This conversation has to happen between the parent and the son or daughter. And when you have conversations like these, the family collectively starts thinking of the value of money and how to best purpose your money. Otherwise, you're just going to purpose your money on a whim or emotion. I think that should never happen. So when you have familial conversations on how much money is coming in, how much is required, how education is being funded, how somebody's health was funded, how contingency is maintained, what kind of spending that family can do in a month, what is avoidable, you can actually eliminate a lot of surprises in the functioning of the family. And when you eliminate all these surprises out, then you see clearly what you need to do. And you focus on that. And you go after that. And you ensure it is accomplished. So that is the kind of clarity that is missing sorely in today's society. And if you are able to have that clarity, you are going to be ahead of that society. And it's a good place to be. That's my view.
We shall continue the discussion going in the second part of the same episode.